Hello and welcome to the Tax Roundup, and what a huge month it's been for tax. We're going to take a look at the changes that have been passed through Parliament for the temporary full expensing measures, but in particular we're going to take a look at those bombshell measures that came through from the ATO impacting on trust and trust distributions. This is the package of alerts, guidance, and also the tax determinations. So Michael, tell me, what has the ATO done and what's the impact?
Well, this month the ATO has released a package of documents that relate to an integrity provision that deals with trust distributions. It's Section 100A in the old Act, and it's referred to as the Reimbursement Agreement Rule. And it's one of those ones that it's been there for a while, but we don't actually see it mentioned maybe as much as we should, and it's something that over time possibly has gone overlooked a little bit. And it's an interesting one because the ATO released some guidance on the website a few years back around Section 100A, which suggested that this was an area that was going to be subject to more ATO scrutiny at some point. And then for a while now, we've been told that the ATO has been working on a draft ruling in this area, but it's taken quite a while to get to the point where it's released. Well, we now have a draft ruling, a taxpayer alert, and also a practical compliance guide, which look at scenarios that obviously the ATO has been concerned about. And the bad news, I guess, for a lot of people is that this is going to mean that a lot of family groups pay more tax in future years than maybe what they were expecting.
So what's the problem and who will be impacted?
Section 100A is aimed at situations, really broadly anyway, where income from a trust is appointed to a beneficiary, but the real benefit of those funds is provided to someone else. And so Section 100A is there to try and counter those types of arrangements. Look, the ATO in this latest guidance seems to have some really specific areas of concern. Probably the big one that comes up a lot in this guidance is distributions that are made to adult children of the family members. And what the ATO is looking at here is situations where income is appointed to, say, an adult child of the family, and then the adult child either releases that unpaid present entitlement, they gift it to maybe their parents, or the income that's owed to them is notionally applied against expenses that their parents might have paid on their behalf, maybe since they were born, so their school fees, etc. And those are the sorts of scenarios that the ATO is seemingly quite focused on. But it's not the only situation that the ATO seems to be looking at. We get coverage of things like circular distributions, where we have a company paying dividends to a trust and they're cycled back to the company again. We were told a few years ago that the ATO didn't really like that sort of arrangement, and that's picked up again in this guidance as well. But look, the ATO is really looking at those situations, particularly within family groups. And Section 100A has an exclusion for ordinary family dealings. And this is the ATO basically saying to us, look, these are the types of things that we think are ordinary family dealings, but these are all the arrangements that we don't think fall within that category. And they are the types of things that a lot of people out there would be doing year on year to manage the effective tax rate of their family group. That's going to be a much harder thing to do going forward. It doesn't mean it's impossible. We are going to need to think about this a lot more closely.
These changes look fairly serious. What's the worst case scenario for a client caught under Section 100A?
Well, Section 100A, when it applies, what it basically does is it says that that beneficiary that you appointed income to, we're going to pretend that they're not entitled to that income at all. And instead, the trustee of the trust is going to get assessed on that income, and that will typically occur at the top marginal tax rate. So if you've appointed income, say, to an adult child, and you've been trying to cap their tax rate at a certain threshold, what can happen is that that income instead gets taxed in the hands of the trustee at the top rate. Now, one of the scary things about Section 100A is it's not subject to the normal amendment period rules. So those normal 2 and 4 year amendment periods that we're used to in most cases, they don't apply to Section 100A. So there is actually an unlimited period for the ATO to go back and look at arrangements like this. And you can imagine there could be quite significant tax liabilities in some cases if the ATO did seek to apply 100A. Now, as part of the ATO guidelines, the ATO is suggesting that they're not necessarily going to go back forever, but there is scope for the ATO to go back retrospectively because that's what Section 100A allows. So there could be some significant tax liabilities if people are in or involved with those higher risk situations that the ATO is outlining.
So we've got all these changes coming through. How do you think the ATO is going to approach this?
Yeah, look, that's an interesting one. And what the PCG does is it actually sets out 4 different risk zones. And if you're kind of in the tax area at the moment, you know that the ATO likes their risk zones. And this is another area where the ATO is basically separating arrangements into different risk categories. So we have a white zone, a green zone, a blue zone and a red zone. Clearly, you probably don't want to be in the red zone. Now, the thing is that a lot of things that some people will think are just normal tax planning strategies, you're going to see them in the red zone. And that's why this is really important to get your head around the examples that are in the ATO guidance, because again, things that a lot of people would consider just normal tax planning, they're pretty high up in the ATO's list of kind of risk zones. So we do need to be really careful. Now, that's not to say that you can never go and appoint income to an adult child to help them cover their uni fees, for example. The ATO is okay with certain arrangements, but we do need to be much more aware of where the ATO sees things as high risk versus low risk. And again, look, it's up to you and your clients how you approach this, but if you don't want to be squarely in the ATO sights, there is certainly a whole range of things that you're maybe going to want to try and avoid moving forward.
Now, bundled into this package of measures is also a determination on Div 7A and UPEs. So, Michael, tell me what's changing.
Yeah, look, this is an interesting one because we've been told by the government for a little while now that they are planning to make some pretty significant changes to Division 7A. And one of the areas that the government flagged was in relation to unpaid present entitlement, so unpaid trust distributions owed from trusts to private companies, related companies. And this is an area that we had to get our head around a new ATO view in this more than 10 years ago, but that position has been relatively steady across that period. But this is potentially going to change things a little bit. And again, we need to be pretty careful on the detail on what the ATO is looking at. Basically, what the ATO has been saying to us in recent years anyway, is that where a trust appoints income to a corporate beneficiary and that's not satisfied or paid out within a relatively short period of time, that unpaid distribution can be treated as a loan for Division 7A purposes. But there are a number of ways you can manage that to avoid the worst of Division 7A so that you don't end up with a large unfranked deemed dividend. One of those ways is to use a complying subtrust arrangement. It seems like not all that many people are going down that path or have gone down that path because there's some complexity to that. But those who have gone down that path have done so because the numbers involved are pretty significant. So changes to that area might have a pretty big impact on them. And it looks like we've got some changes in that area. Beyond those complying subtrust arrangements, the way we manage those unpaid present entitlements, often in practice, is using a normal Division 7A loan agreement. And again, for the last 10 years or so, we've had a pretty settled understanding of the timing rules around that. That is now changing in some situations.
So from a timing perspective, how is this all going to really work?
Yeah, it's one of those ones that's a little bit hard to explain, but I'm going to give it my best shot. So the way this has worked in recent times anyway is, let's say we get to the end of the 2021 income year and a trustee appoints some income to a related company. And let's assume that's not paid out straight away. Well, the ATO says that if you don't pay that out within the following income year, or by the time the trust needs to lodge its return for the 2021 year, and you don't put a subtrust arrangement in place, so we'll discount that for the time being. Basically, the ATO says we're going to pretend as if the company had lent the money to the trust. So we now have a Division 7A loan in many cases. You then have some time to pay that off or put a complying Division 7A loan agreement in place. And the way that timing works is it kind of buys you an extra year. So we kind of have this year of grace where you can kind of leave the thing unpaid for a little bit longer before you need to put your Division 7A loan agreement in place and before minimum repayments need to start being made. Well, the ATO is suggesting in this new draft determination that that timing might change and that you might lose that year of grace in some cases. Now, the situation where that would be a concern is where the trustee appoints a specific dollar amount to the company. So the trust resolution might say, trustee has decided to appoint $100 exactly to the company. Well, what the ATO is saying is that if we're dealing with related parties, The minute that happens, the company is assumed to be aware of that entitlement to a specific amount. And so the loan is made instantly after that. And so that brings us forward in terms of when we need to have our loan agreement in place, if that's what we want to do to manage the problem, and then make minimum repayments. But you can end up with a different scenario, and we kind of go back to where we were before, if the amount appointed to the company can't be immediately determined in exact dollar terms. So let's say the trustee says, rather than appointing $100 to the company, the trustee appoints 12% of the income for the year to the company. Well, the ATO says, look, in most cases, you won't know exactly what the dollar amount is until after year end. And once the trustee has figured out that amount, the company is then assumed to know it, and you now have a loan being made if it's not paid out straight away. So that's where you get that extra year of grace built in again, back to kind of where we were before. So the way the trustee words its resolutions and the way income is appointed to a company can be the difference between a year earlier or later in terms of Division 7A loan agreement and minimum repayments being made. Now, we need to think this through, and because often things are more complex than that. What if the trustee appoints the first $100 to the company? Do we know for sure that there's going to be $100 or not? If so, maybe we have a year earlier. If we don't, maybe we get that extra year. These are the things that we're going to have to think about very carefully. If the company is entitled to the balance, the rest of the income, my guess is that that probably will buy you the extra year, because you probably won't know exactly what that number is until after year end. So these are the issues we're now going to have to grapple with when it comes to UPEs and Division 7A loan problems.
The Div 7A already seemed complex, and it looks like it's getting a bit more complex now. So what else do I need to know? What do I need to be aware of?
Yeah, well, look, the good news, if there is any good news out of this particular change, is the ATO isn't going to do this retrospectively. This is something that is coming. So the ATO basically will leave things as it is for prior years and for the 2022 income year. The way we've been dealing with this doesn't necessarily need to change straight away. Having said that, remember the ATO's guidance around Section 100A, that could be relevant when you're distributing to companies as well, and we need to factor that in. So these two things do need to be looked at in conjunction. So we don't necessarily have to change things straight up when it comes to the Division 7A issue. The other thing to keep in mind is, again, thinking, well, what happens if I mess this up? Well, if you mess it up and say the loan is deemed to have started now rather than in 1 year's time, what that means is you may be late in putting a complying Division 7A loan agreement in place or paying off the loan in full. Now, if you do that, that means there is probably a deemed unfranked dividend that's been triggered. So you've appointed income to a company, the company's probably paid tax on that at whatever the corporate tax rate is for that particular company. If you have a Division 7A problem in relation to that unpaid balance, that same amount is going to be assessed again in the trust, and that could mean a significant tax liability either for the trustee, penalty rates might apply, or for one or more of the beneficiaries of the trust, depending on how trust resolutions are worded and the wording of the trust deed. So when you make a mistake in this area, what often happens is you end up with double taxation on the same money. And so the profits that were made in the trust that have been distributed to the company that initially we thought were being taxed at a pretty low rate can end up being taxed at an extraordinarily high rate. And it's not very good tax planning. So we really need to get across this and make sure we get it right. But we do have a little bit of time to kind of understand this and what it means from a practical point of view.
And finally, Matthew is going to take you through those changes that have just passed Parliament on the temporary full expensing measures. Matthew, tell me what's changed.
Yeah, so that's right. In the recent budget, the government announced that they were going to extend temporary full expensing for 1 more year, so till the end of 30 June 2023. That legislation has just been passed. So what that means is that if you've got clients who have an aggregated turnover of less than $5 billion, they can claim an immediate deduction when they purchase depreciating assets to use in their business. And unlike the previous instant asset write-offs, there is no limit to the cost of these assets.
Before clients go off and spend a small fortune utilising the temporary full expensing measures, what do they need to know?
That's a really good question. So before clients go out and spend a whole bunch of money on depreciating assets and claiming an instant deduction, at least in the 2023 income year, you just really want to be a bit careful and try and model out what their tax position would be and whether that creates a tax loss, because a tax loss, probably isn't all that useful. Now, if the client is a company, there were some proposals to extend the loss carryback measures also into the 2023 income year. It doesn't look like those measures have been introduced or passed yet, but as far as I'm aware, the intention potentially is still there to extend those provisions into that 2023 income year, just to align with the extension to temporary full expensing. So look, there's nothing wrong with buying assets to use in your business, but you just want to model out what that tax position would be, and that might depend on the taxable income of the client in that year, and whether if they're a company, and whether they can use that loss carryback measures to carry back their losses against prior year tax profits.
And that's the tax roundup for this month. It's been another big month, and of course we've got more coming with the budget being handed down in March this year. If you're on Knowledge Shop's database, we'll send you a copy of our analysis specifically for advisors and your clients the morning after the budget. If you're a Knowledge Shop member, we'll also send you that white label version that you can use and adapt and send to your own clients to ward off any of those questions that might be coming through. Now, if you're not a member of Knowledge Shop and you'd love to talk to the team about what we can offer your practice, give Claire a call on 1800 800 232. We'd love to show you what we do. Anyway, until next month, we'll see you then.